Welcome to Module 2 of the e-course on carbon taxation. In this module, we set out to differentiate common policy objectives associated with carbon taxes, describe factors for framing the national context, and outline criteria for evaluating carbon tax design. The Paris Agreement entered into force on 4th of November 2016. To date, over 160 parties submitted the so-called Nationally Determined Contributions, or NDCs, which lay out what measures each government is planning to take to mitigate and prepare for climate change. About half of the NDCs explicitly mention carbon pricing, the large majority of which envisage some type of international scheme. A smaller share of that group is considering domestic carbon pricing as well. The Carbon Pricing Dashboard, developed by the World Bank with Ecofis, is a practical online tool that visualizes existing and emerging carbon pricing initiatives. Find out which countries are preparing for potential adoption of carbon pricing schemes with the help of the online tool. For example, on the right side of the tool, under the Status section, click on Under Consideration. On the map, you can zoom into the region of interest or click directly on a country or subnational jurisdiction to learn more about what the respective governments are doing. Consider Turkey and Vietnam. Both countries initiated formal deliberations on pricing carbon in their jurisdictions. Despite their geographical distance, they are considering a similar approach. Which one? Let's explore with the help of the tool. Before a government proposes the adoption of a carbon tax, it is important to engage in a process which examines all available options and considers them in light of the relevant context. Engaging in this process early on ensures that the tax is well designed and responds to both policy objectives and national circumstances. This shall enhance political acceptability of the tax and reduce the likelihood that substantial overhauls will be needed in the future. The three questions shown here are regarded as key before examining more technical details of carbon tax design. It is important to note that they are closely related, and when designing a carbon tax, they should be considered together. For instance, the principles of carbon tax design will reinforce policy objectives, while policy objectives will be influenced by national circumstances. Within the course of this module, we examine main policy objectives, national context, and principles of carbon tax design. Carbon taxes have the potential to achieve a range of different policy objectives. The relative importance the government places on these objectives is a crucial factor in informing policymakers' design choices. An essential first step in carbon tax design is to clearly define the objectives the government seeks to achieve through the tax. While most governments considering the adoption of a carbon tax will have a fairly clear idea of high-level objectives, such as reducing greenhouse gas emissions or raising revenue, the definition of these objectives should go further and consider the specific targets pursued within these general objectives, as well as their relative importance. This section first discusses four main objectives that drive carbon tax adoption: greenhouse gas emission mitigation, revenue raising, low carbon development benefits, and increased efficiency of the tax system, and the specific objectives to be determined in each case. Jurisdictions can pursue the four objectives in concert, as they are not mutually exclusive. However, given their interdependent nature, trade-offs may arise. Broadly speaking, raising carbon tax revenue can have two motives. One relates to generating additional revenue, for example, to support general government spending or specific purposes. The other motive is to use carbon taxes as a substitute for other sources of revenue. Several jurisdictions have adopted revenue-neutral carbon taxes since they allow them to reduce taxes in other areas, for example labour or corporate taxes. Revenue-neutral designs are sometimes framed as environmental tax shifts. Such tax shifts evoke the idea of taxing bads, such as air pollution, rather than goods or desirable outcomes, such as labour or income. Within the broad objective of raising revenue, two questions stand out. How will the revenue be used? How much revenue is sought for each specific area of funding? The responses to these questions affect the design of a carbon tax. Let's see how in the next two sections. Governments have used resources for a wide range of purposes. The decision to use revenue for an explicit purpose is usually informed by a specific rationale. Can you match purposes and rationales for the cases presented? The amount of revenue sought will have an impact on carbon tax design. For example, where significant revenue is sought, governments may choose to include more sectors, or those with the highest level of emissions and/or highest ability to pay. Carbon taxation can be a powerful trigger to improve the efficiency and effectiveness of the tax system. But what does that mean? Looking at the benefits presented here, can you distinguish actual and false benefits in relation to the tax system? As carbon taxes have been in use for over 2 decades, there is evidence suggesting lower tax loss levels for carbon and similar taxes on fuels as compared to most other taxes. Besides the central objectives of emissions mitigation and raising revenue, several jurisdictions cite a range of aims relating to low-carbon development or environmental protection as additional objectives behind the introduction of a carbon tax. In many developing countries, incentivizing the development of new or nascent economic sectors or addressing local environmental issues are often more immediate and pressing political objectives than greenhouse gas mitigation. Carbon taxes can support these and other policy objectives in two major ways. Firstly, they can provide an incentive for shifts in behaviour and investments. Think of carpooling, higher usage of public transportation, or investments in renewable energy and the retrofitting of buildings. Secondly, they can raise revenue that can be used to fund programmes or incentives that further support those aims. Examples include financing innovative pilot projects in the transport sector, or installation of smart meters in homes that optimise electricity usage. Importantly, these two effects can be mutually reinforcing. The incentive provided by the tax, combined with the incentives funded by tax revenue, work like carrots and sticks that support the government's policy. With countries and subnational jurisdictions adopting quantifiable mitigation targets, whether as absolute targets or as a range of relative and intensity-based targets, carbon taxes are becoming an increasingly prominent policy tool to achieve them. The more specific an emissions objective pursued is, the better the tax can be designed to support it. The first and most obvious specific objective a jurisdiction must determine is the emissions target it seeks to achieve and over what time frame it is pursued. Most countries have already defined such targets as part of their nationally determined contributions, as well as through national or subnational climate policies and strategies. Targets may apply to the whole economy, to specific sectors only, or to both. A second feature to determine is the emissions trajectory the jurisdiction seeks to achieve over time, or, in other words, the rate at which it wishes emissions to decline, or the date by which emissions should peak, plateau, and subsequently decline. The two figures illustrate potential emission reduction trajectories in jurisdictions with the same absolute emission reduction target. While in country A, emissions are reduced gradually from the base year, 2015, to the target year, 2030, in country B, emissions rise slightly before peaking, plateauing, and then declining to the target. Naturally, in country B, the decline happens much faster once it sets in, because it needs to compensate for the country's growth since 2015 to be able to meet the same target. In addition, its total emissions over the period 2015 to 2030 are substantially higher than in country A. Since the intended trajectory affects how much emission reduction a jurisdiction seeks to achieve over a period of time, it influences the modalities of a carbon tax over time. For instance, a jurisdiction may expand the tax to more sectors, or gradually increase the tax rate to achieve a certain emissions trajectory. As well as defining the emission reduction target and trajectory, it is important for policymakers to consider the role or contribution of the carbon tax in achieving the target. Carbon taxes can be the central instrument or a complement to a range of policies to achieve mitigation objectives. It is common for countries and subnational jurisdictions to tax goods and processes that produce greenhouse gas emissions. Think of electricity or excise fuel taxes, for example. Originally, some of these taxes may have been designed to raise revenue rather than reduce emissions. For example, in the past, fuel taxes usually added a certain amount on the price of a litre of fuel rather than linking the tax to the carbon content. Given that, in effect, such taxes disincentivize emitting activities, they are commonly included in the so-called effective carbon rate. For instance, by calculating the effective carbon rate, Jurisdictions can understand the interactions of these different instruments in creating a price signal for a given sector. The effective rate is the sum of energy taxes, carbon taxes, and ETS's costs on a given fuel. The better a jurisdiction can define what policy mix it will use to achieve its objectives in various sectors, the better positioned it will be to define the carbon tax in a way that fits its intended contribution. However, using multiple policies in parallel in the same sector to create financial incentives can be inefficient as they increase administrative costs. Governments sometimes do this because, for example, the incentive of any one alone is not enough, or they want to balance instruments that raise revenue with those that cost money, or they have to meet multiple objectives. Having defined the policy objectives sought by the carbon tax, it is important for policymakers to have a clear picture of the relevant national context. Country circumstances affect a wide range of decisions, from whether to adopt a carbon tax to determining the tax design options that are best suited to the jurisdiction. In your view, what are major country circumstances to consider around decisions on carbon taxes? Write them down in the notebook. We will come back to this later. Early consideration will be particularly important for circumstances that are not immediately obvious and therefore require further investigation. Major factors are government capacity, the economy's emissions profile, economic context, and political feasibility. These factors will have the greatest influence on carbon tax design. Carbon pricing designs vary significantly in terms of their administrative complexity. Different carbon taxes themselves require different degrees of oversight and monitoring. The determination of the required capacities has to be based on the needs of different design options. For example, whether the tax is applied upstream on fuels or downstream on emissions significantly determines administrative needs. Similarly, adopting features such as offsets, conditional rebates, or emissions trading systems will require additional administrative capacities to flat rate solutions. On the other hand, studying the experience of jurisdictions with similar circumstances and speaking to counterparts in those jurisdictions can also help to understand how these needs play out in practice. Where it is not obvious that existing country capacities match up to the needs of given design options, governments can use a range of capacity needs assessment tools or integrate capacity building into the design of the carbon tax. Before engaging in the details of carbon tax design, it is worthwhile for jurisdictions to do some preliminary data gathering. Mapping greenhouse gas emissions in the jurisdiction is central to determining where the largest emission sources are, and therefore where the tax may have the biggest impact on emission reduction and revenue raising. Jurisdictions' emissions can be broken down by economic sector or by emission sector, as defined by the Intergovernmental Panel on Climate Change, or IPCC. The more disaggregation is possible in mapping emissions, the more useful it will be for policymakers deciding on what to direct the carbon tax at. To better understand the potential impact of a carbon tax on emissions, jurisdictions can engage in economic analysis, which can range from simple study of elasticity of demand in key markets to advanced modelling of the entire economy, thus capturing the interaction across sectors. When using price signals as an instrument, policymakers need to ensure that prices are indeed formed by liberal markets. Some jurisdictions have therefore introduced carbon taxes together with broader liberalisation of the energy sector. In jurisdictions with high public concern over climate change and support for green industry, carbon taxes can enjoy significant public support. However, carbon taxes can be unpopular in jurisdictions where addressing climate change is a lower priority, and the tax burden is already considered to be high. It is therefore worthwhile for jurisdictions to conduct a general assessment of the political climate through stakeholder consultations before deciding to move forward. Continuous assessments throughout the process of designing, adopting and reviewing the carbon tax are also useful. There are concrete design options that policymakers can choose to increase acceptance among stakeholders. Consider the choices shown here. Experience with carbon taxes suggests that some of them are particularly conducive to foster public acceptance. Can you tell which ones? We have reached the end of this section. Remember the factors you wrote down in the notebook? To summarise, let's compare them with the discussion in the previous sections. As discussed in the previous sections, jurisdictions can prepare for the carbon tax design process by identifying and prioritising their objectives, and by clarifying the salient elements that define the national context for the new tax. In addition to this, it is useful for governments to have a set of criteria to evaluate alternative carbon tax designs that will meet their policy objectives. The Organisation for Economic Cooperation and Development and the World Bank have developed a set of principles to guide carbon pricing design generally, the FASTA principles. While the principles provide a solid foundation, they are not necessarily exhaustive. Policy designers will need to add or customise principles to their jurisdiction's specific contexts, including their social values, priorities and circumstances. For example, legal feasibility may be relevant to determining whether a particular design option is permitted by relevant national laws and administrative structures. How can policy designers use the principles in practice? Consider the following series of questions. Each one of them specifies what challenges the FASTA principles seek to respond to during design. Drag and drop the principles accordingly.